Alright, we're continuing with Chapter 9, starting with Slide 27 on accounting for plan assets and illustrating the declining balance method. So this example, that's also shown on page 477 of the text, shows how the declining balance depreciation expense per year is computed. The declining balance rate stays constant at 40%, but the amount it's applied to each year is the current book value, which is declining due to subtracting the accumulated depreciation from the original cost, or the beginning book value. Therefore, you can see that the depreciation expense is much greater in year 1 using this method than straight line method, and than it is in future years. By year 3, the declining balance depreciation is actually less than it would be using straight line. However, the overall depreciation over the 5 years of asset life is the same under both methods, and that's an important thing also for you to recognize and remember. Excuse me. On slide 28, in the units of activity method, the company must make a reasonable estimate of the activity anticipated to occur over the asset's useful life. In the text example, they are assuming that the truck will be driven 100,000 miles in 5 years. As shown on page 476, this works out to 12 cents per mile of depreciation expense based on the depreciable cost of 12,000 divided by the estimated 100,000 miles of use. Then the actual usage in miles each year is multiplied by the 12 cents per mile to get the depreciation expense for the year. Again, the total depreciation over the 5 years of useful life should equal that calculated using the straight line or declining balance methods. Only the amounts per year will be different. On slide 29, here is a continuation of the units activity example shown on page 478 of the text. Note again that the total accumulated depreciation after 5 years of use will equal the accumulated depreciation for the other depreciation methods, and only the annual amounts differ. As the text also notes, this method is not used very often because not all fixed assets have reliable units of activity that can be used as a basis for determining depreciation expense each year. And obviously, if the estimate is wrong, then some type of adjustment is going to be needed at some point during the useful life of the asset, which further complicates things. On slide 30, the comparison chart shown here confirms that under each method, the accumulated depreciation over the 5 years of the asset's use is equal. That is $12,000, which is also equal to the original depreciable cost. Note that the line graph, though, that shows that the often drastic differences in annual amounts between the methods. On slide 31, as stated before, depreciation for tax purposes is different than for financial accounting purposes. The accelerated method allowed for tax purposes, referred to as makers, is not acceptable for use under GAAP for financial accounting purposes. On slide 32, this slide shows an example of a disclosure note regarding depreciation. Notice that amortization of leased property under capital leases is also included in depreciation expense, although this is beyond the scope of this course. On slide 33, depreciation calculations can be revised based on new information during the asset's useful life. As stated on the slide, this does not mean a retroactive correction needs to take place, only that the period of change and future be accounted for in the new way. This is what is called a change in estimate versus a change in method. On slide 34, in this example, the company decided in year 8 to make an adjustment from a 10-year to a 15-year useful life. However, no adjustment will be made to prior years since this is considered a change in estimate and not an error correction. They also decided to lower the salvage value from $10,000 to $5,000, apparently based on current market trends or other updated information. Note, as shown above, that there is no journal entry needed to correct prior year's depreciation. Again, this is a change in estimate, not an error correction. Now on slide 35, now to compute the new annual depreciation expense, we first need to determine the current net book value that we will use as a basis for the remaining useful life of the asset. This is computed above based on the original cost less the accumulated depreciation over the first 7 years, as we are now in year 8. That yields a net book value of $160,000 as shown. And moving to slide 36, we next calculate the new depreciable base, which is the current book value less the revised salvage value of $5,000. Then we take that new depreciable base, or cost, of $155,000 and divide it by the number of years of useful life now remaining, which is 15 minus 7, or 8 years. And that gives us our new annual depreciation expense of $19,375 per year. This is, of course, using the straight line method. Note that this amount of depreciation per year is considerably less than what was computed in the first 7 years, that is $50,000 per year. But that this is not considered an error, again, just a change in estimate. Moving to slide 37, it's important to be able to distinguish between ordinary repair and maintenance expenses, that is, expenses of the period, that are incurred to maintain the asset in its current state, versus additions and improvements that are incurred to increase the operating efficiency, productive capacity, or useful life of the asset, and therefore need to be capitalized, that is, debited to the asset account affected, which of course will also affect the annual depreciation, because you would now have a higher depreciable cost. And on slide 38, as shown in this WorldCom example, it can make a world of difference, pun fully intended, in the bottom line as to how asset-related costs are handled, whether as expenses of the period or capitalized so that expense recognition is deferred mostly to future years. The improper treatment of a significant expense item as a capital improvement was a big part of the accounting fraud that WorldCom engaged in to prop up their net income falsely. Now on slide 39, as stated on this slide, an impairment is a permanent decline in the fair value of an asset, which can be brought about by actual damage or other factors such as partial or total obsolescence. A GAAP requires companies to write down assets to reflect this decline in value that an impairment causes. On slide 40, as stated on the slide, there are 3 ways that an asset may be disposed of. If the asset still has some value on the market, it can be sold or exchanged for another asset. If not, the asset can simply be retired, that is, scrapped or otherwise discarded for nothing except perhaps a nominal amount for recycling metal and so forth. The asset is normally eliminated from the accounting records by a debit to accumulated depreciation and a credit to the asset account. Well, why would that be? Well, because in writing off the asset, we also need to write off the accumulated depreciation that's associated with it. On slide 41, book value is the measuring stick for whether or not a gain or a loss is made on the sale of an asset. As noted on this slide, if the sales proceeds exceed the book value, a gain on disposal occurs, and vice versa when a loss occurs. And moving to slide 42, to determine the gain or loss on this sale, we first need to determine the up-to-date book value of the asset. The first entry shown here on the slide adjusts the depreciation to its current accumulated total, that is $41,000 plus $8,000 in the current period up to the time of disposal equals $49,000 in total. And on slide 43, therefore, the up-to-date book value of the asset is $11,000, $60,000 original cost minus the $49,000 total accumulated depreciation. Since the proceeds were $16,000, there was a gain on disposal of $5,000, that is $16,000 minus $11,000. Proceeds were greater than book value in this case. And note how the journal entry captures all aspects of the asset sale. the cash proceeds received, the write-off of the asset from the accounting records, and the gain on the asset sale, all captured in one entry. Note that the gain, of course, is a credit because it's an income type account similar to sales revenue. On slide 44, now we'll see an example of the opposite situation where sales proceeds are less than the current book value. As noted on the slide, this produces a loss on disposal of $2,000. That is $9,000 in proceeds minus the $11,000 book value. Note again how the journal entry captures each part of the sale and how the loss on disposal account is debited because it is a loss account versus a gain account that, like sales revenue, as pointed out on the previous slide, has a credit balance. On slide 45, retirements are usually pretty straightforward as far as the accounting. A write-off to the accumulated depreciation, which is a debit, and to the asset account, which then is a credit. On slide 46, to answer the question on the slide, the write-off would not occur until the asset is physically retired, even though it's fully depreciated. So an asset can go on being useful and productive, sometimes well beyond when it's fully depreciated. On slide 47, since fixed or plant assets comprise such a large percentage of most companies' balance sheets, management wants to know what kind of return the assets are providing to the company. One measure of this is the return on assets ratio, which divides net income by the average total assets for the year. Now notice that's average total assets, not just plant assets. Of course, plant assets normally is a pretty big part of that. In the airline industry, this return is slightly under 4%, as shown on the slide as far as industry average. Therefore, AirTran exceeded the industry average in 2009, while Southwest fell under it in 2009, although it improved considerably from 2008. On slide 48, this vignette on marketing return on investment, or ROI, discusses how marketing executives use this measure to determine the effectiveness of their marketing initiatives. See page 499 for further discussion of that. And with that, we'll wrap up this part of the presentation.